I'm Joseph Ranke, the host of your podcast today. If you're watching on YouTube, welcome there as well. If you are on the podcast, be sure to share it with your friends and subscribe to our channels. Let it be on Spotify or Apple iTunes or whatever it is. Also, if you're on YouTube, make sure you subscribe, leave comments, questions, all that type of stuff. It helps grow and let other people know about these videos. That can definitely help them. So, welcome. Our topic today, getting a mortgage while on student loans. Okay, one of the biggest questions we get all the time about this, and the crazy part is it's hard to get answers. Okay, piece of advice number one, you got to find a mortgage broker that knows what they are doing with these. Okay, and what I mean by that is you have these big box lenders, and by big box I mean places like Wells Fargo's, the Bank of America's and whatnot. Okay, the problem is they have these computer systems where they literally just plug in information and go, they just spit out mortgages left and right. And if you're on student loans and you're on various different types of plans, they don't fit those cookie cutter models. So oftentimes they're going to come back and spit out a decline message. Okay, therefore you have to go to a mortgage broker that knows what they're doing, because that's the way you're going to be able to qualify for these things. Okay, so if you've been denied before, this video is definitely going to help you. This podcast is going to help you. If you've been in a situation where you're trying to apply and it doesn't seem like you're getting enough loan, this podcast is going to help you. If you are sitting there saying, look, I'm planning on buying a place in the next 6 to 12 months, this podcast is going to help you. Okay, so let's jump right into it. Okay, there's different types of mortgages. Okay, they all have different guidelines. So first of all, you might hear things like Fannie Mae, Freddie Mac, FHA. Those are the big three that people listening to this podcast, that's what you're going to qualify for. Okay, there's other ones like Ginnie Mae and VA. We're not going to touch on those in this podcast because those are very, very, very specialized types of topics. So again, buzzwords, if you hear these from your lender, your real estate agent, whatever it is, Fannie Mae, Freddie Mac, FHA, those are what we're going to be discussing today. Okay, now on top of that, I'm going to discuss two different mindsets you got to have when it comes to student loans and mortgages. For those of you that are doing a payoff strategy versus those of you that are going to be doing a loan forgiveness strategy, your student loans will affect your mortgages differently. Okay, so the first thing we're going to do is jump into payoff strategies first and what you need to know here. Okay, now I'm not going to deep dive too much into this, but most of you that do a payoff strategy, you do one of two things. Either A, you stay on a standard 10-year plan, okay, because that's the default when we come out of our grace period and enter repayment, or you refinance into a shorter term loan. Okay, so I'm going to tackle both of those in some ways around qualifying for a mortgage. Okay, instead of doing a standard 10-year plan, you can actually extend the loans out to 25 years. Okay, now what does this actually do? Let's just say I had $144,000 in student loan debt, and I'm on a standard 10-year plan. My monthly payment would be about $1,600 a month. Okay. The key to understanding all this is what's called the debt to income ratio. Okay. Now, when you're looking at a debt to income ratio, what that means is what percentage of my income every month goes to things that are debt and my required monthly payment. So if I have, a $1,600 required payment, they're going to add that into this calculation. Then they're going to add in my car loan, and then they're going to add in if I have credit cards. And then they look at it and say, okay, what about a mortgage payment, homeowners insurance, and property tax? Okay, and if you're doing less than 20% down, PMI, it's just property insurance or mortgage insurance. I'm sorry. Okay, PMI. They take all these things, they add them up. Okay, it cannot be higher than a 45 to 55% DTI ratio, depending on which loan you go into. So I'll give you an example. Let's just say I make $5,000 a month. Okay, and that's my gross income. Now let's just say all those things, I have a car loan and I have a student loan, and then I'm going to have payments and whatnot. At a 50% DTI ratio, that means that all that has to be $2,500 or less. If it's above $2,500, Sorry, not getting a loan. Okay, so those are the DTI ratios that you got to look at, 45% to 55%. Okay, so now let's look at this. I'm on a standard 10-year plan. I told you that my monthly payment would be about $1,600 a month. That means for all my other debt. So if all I had, that's all I had in my debt, and let's just say I was looking for a mortgage, my property insurance, or my property tax and my homeowner's insurance would have to be $2,500. Let's just say it's 50% is what I have to qualify under. $2,500 a month minus my $1,600 a month payment for my student loans leaves $900 a month. That means that all my mortgage and everything has to be $900 a month or less. Okay? A lot of you looking at that like, there's no way in hell I'm going to be able to buy a house with that. And you're right. Okay? Now this is what you can do if you're in your federal loans. This is what you can do to manipulate these numbers. Okay? Instead of doing the standard 10-year plan, you can do like I said earlier, where you extend it to 25 years. What that does is drop your required payment. So in my example, my required payment on my student loans would drop from $1,600 down to $900. That's like $700 I'm freeing up for that calculation. What does all this mumbo jumbo mean? In short, in my example, by dropping my required payment, that $700 on my student loans, I now qualify for an additional $150,000 of mortgage. Okay? So it basically, in short, dropping your required payment on your student loans makes it easier for you to qualify for a mortgage. So if you're doing a payoff strategy, going from 10 years to 25 years makes it easier. Now, that's the key thing. If you go from 10 years to 25 years on your student loans, and all you do is pay the required payment over the entire 25 years, it's going to cost you a shitload of money. So you want to be strategic about it. You want to extend it, drop the required payment, and then get your house, and then go back and still make bigger payments on your student loans and still pay them off in 10 years. Okay? You don't want to pay the small payment for 25 years. It's mind-numbing. You just cost yourself a ton of money. Okay? So that's 10 years versus 25 years in your federal loans. Now, refinancing your student loans. Oftentimes, you guys have heard me say on different podcasts, different videos, different blogs, workshops. Student loan refinancing is more than just saving money. Okay, you hear me say that all the time. Okay, this is one of those situations that it's more than just saving money. I see people do this all the time. They're like, "Yeah, I want to buy a house," and they don't come to us for help, and they just go on there. I need to refinance student loans because I need to save money. I need to get a lower interest rate. So they go and look at interest rates, and they'll see like a 5-year loan at the lowest interest rate, and it's like 3.9%, and the 10-year loan is at like 4%, basically 0.1% difference. The interest rate's really not saving them that much, but they don't do the calculation to figure out how much it's saving them. And instead, they're just so gung-ho on getting the lowest interest rate, they do the 5-year loan versus the 10-year loan. Why is that a problem when it comes to home buying? You have a higher required payment on a 5-year. Therefore, using a 5-year versus a 10-year loan is going to make it really hard to get a mortgage. So if you know one of your goals is getting a mortgage, you may want to look at doing a 10-year loan or a 15-year student loan refinance or a 20-year student loan refinance. And even if you do the 15 or the 20-year student loan refinance, then you just turn around and make bigger payments and still pay it off in 10 years or 5 years. You could do that. Or you get the house and then you refinance again and go into a shorter term if you want to. Okay. Now, if you guys want help on that, you guys know this already. We have a free student loan refinance service. We work with 9 of the top lenders in the country. Just build your profile, schedule a time. We'll go through all those calculations with you to make sure you're not hamstringing yourself, that you're not screwing yourself. We'll show you the 10-year versus the 25-year on the federal loans and all that stuff. So if you guys need help on that, you don't need to memorize all these numbers and everything, but we can definitely help you with that. Okay, so those are the payoff strategies. Just to recap that. If you're in your federal loans, going from 10 years to 25 years will drop your required payment. That basically makes it easier for you to qualify when it comes to your debt to income ratio because you drop your required payment. In the example I gave you, by dropping the required payment $700, it allowed me to qualify for an additional $150,000 in a mortgage. Okay. The second part of that is student loan refinancing. Being strategic with it. Don't necessarily just chase the lower rate, because you may hamstring yourself in the future. Be strategic with what you're refinancing. Make sure that it fits your goals, your plans, and everything else that you're trying to do, and your budget and everything else. Okay? Those are payoff strategies. It's a lot simpler for buying a house on those. If you're on a loan forgiveness strategy, a lot harder to qualify for a house. This is really that whole quote unquote big box lender thing I told you guys at the beginning, where it's like, hey, I go into Wells Fargo, I go into Bank of America, and they're denying me. It really happens when you're on one of these loan forgiveness plans. Now, first off, what do I mean by loan forgiveness? If you're on pay as you earn, REPAYE, which is revised pay as you earn, PAYE, IBR, income-based repayment, IDR, income-driven repayment, PSLF, public service loan forgiveness, all these different acronyms, they're all student loan forgiveness. Okay? In the financial world, if you hear your broker or something like that say, your mortgage broker say you're on a non-amortizing loan, they are referring to student loan forgiveness. Okay? Now, this is why a lot of you have been having questions, is because when you're on one of these plans, let's just say you have a $0 payment. They might not necessarily use a $0 payment. So for example, if you have an FHA loan, it doesn't matter what your monthly payment is on your student loans. On an income-driven repayment plan, they automatically use 1%. So like in my example, I have $144,000 in debt. Okay? If I was going on an FHA loan and I was on a loan forgiveness plan and my payments were $0 a month, they don't use that for FHA. They use 1%. Therefore, they're going to factor in a hypothetical $1,400 payment a month. It's going to be really hard for me to qualify for a loan. Okay? Now, Fannie Mae and Freddie Mac are the other ones. They will actually take your $0 payment or the actual payment that you have on your credit report. So like if your income-based repayment plan is $300 a month, great, they'll take that, okay? That's another trick for you. For some of you that are actually doing a payoff plan, if you really wanted to qualify for a mortgage and you just couldn't, you could potentially switch to a loan forgiveness plan, get your low payment of $200, $300, $400 a month, qualify for the mortgage, get the mortgage, and then switch back into a payoff strategy in your federal loans. Definitely can do that, okay? But this is why so many people are getting confused, especially right now with this whole thing with COVID and everything else. On your income-driven repayment plans, if you are in deferment or forbearance, okay, they do not use the $0. They assume 0.5% on your monthly payment for Fannie Mae and Freddie Mac, and if it's FHA, it's still the same 1%. So what does that mean? Why is this so important like right now? Okay. On March 13th, 2020, the government put everybody into forbearance on these plans automatically. That means you don't have a monthly payment. Therefore, you don't show $0 on your credit report in the eyes of the lender. They're going to factor this at 0.5%. Okay, so some of you that had like monthly payments of $200 or $300 before this whole COVID crisis thing that's going on, and now that dropped down to $0, it's not that you have a $0 payment, it's that you're in forbearance. So the only way you can get out of that is wait until this forbearance period is over in September and then go get your mortgage. Or you have to call your loan servicer and say, look, I want to resubmit and go on to a loan forgiveness strategy and a loan forgiveness plan. And then they'll redo all the paperwork. It's probably going to take them about a month to process it all. And then they're going to come back and say, here's your monthly payment. So in your situation, you got to decide, do you really want the house? If you so, you got to get back onto the income-driven repayment plan. Or would you have a $0 required payment from now until September 30th, and you'll just start making the payments later and qualify for the house later? Okay? A lot of numbers I just threw out at you guys. Don't need to know all that. Okay? Just know this. If you're doing a payoff strategy, doing a loan forgiveness strategy, the key things that student loans affect is your debt to income ratio. For those of you that don't know, okay, and I'm just throwing this one bit of tidbit in, there's 3 things that factor into you getting a mortgage. Okay? Your credit score, the loan to value, meaning how much are you putting down for a down payment, okay, and your debt to income ratio. Earlier I said that debt to income ratio, I used an example of 50% of my income being in my debt to income ratio, and it ranges between 45 and 55%. Basically, what determines that 45 to 55% are the first two items, your credit score and the loan to value. That's what determines your max DTI ratio. Okay, so it's a factor of all those. But if you're just trying to get a feel, I would say 45 to 55%, and you can see where your numbers fall out at and say, look, if I'm on an IDR plan, do I need to do something to change my debt to income ratio? If I'm on a payoff strategy, do I need to do something? How bad do we want the house? All that type of stuff. Again, we deal with these questions every single day. That's why I decided to do this podcast, especially right now because of everything going on with COVID. People are getting denied. I mean, this last week, I got at least one email a week about this, at least. Okay, and we don't even do mortgages at FitBucks yet. Yet, I say, keyword, hopefully 2021, 2022, maybe we will be. Just wink, wink, future projection right there. But yeah, we don't even do mortgages yet, and we're still getting these questions. And that's just this, like last week, like this month, since March and all that stuff. I mean, I'm getting multiple questions on this stuff a day because people get denied when they're on the income-driven repayment plan because they're in forbearance. All right? So, again, summarize. It's all about your DTI ratio when it comes to mortgages and student loans. Payoff strategies, you got to figure out how can I manipulate this required payment so that way I can qualify. If you're on an income-driven repayment plan, you need to realize, hey, they're either going to, if I have a payment, they're going to take that, depending on which loan it is. If I'm in forbearance, they're going to assume 0.5% or 1% for my monthly payment. Would I still qualify? Okay. So, as always, that's our podcast for today. If you're watching on YouTube, thank you again. Make sure you do subscribe. Make sure you share this with everybody that you guys know. Share it across all your social platforms, all that stuff. It helps us. It helps people that you know, your colleagues, your classmates, your friends. Get them the information as well. If you have any questions, build your profile, schedule a call. We'll be talking to you soon. Peace.